All right. Well, hello and welcome again to the next installment of the Maximum Performance webinar series. My name is Eric Janesco, head coach and CEO for Maximum Acceleration, the professionals coaching company. And of course, we started this series a little over a year and a half ago. Actually, in October, almost 2 years ago, October of 2012, we started this series with the intent of bringing a community of learning together for top mortgage and real estate professionals, giving you the guidance, support, and information you need to help you grow your business faster. Our only goal being helping you get from where you are to where you want to be as fast as humanly possible. And of course, today's topic is brought to us in conjunction with CRE Credit Services, one of the premier credit repair and credit coaching agencies in the country. Brought with us our guest presenter, Mr. James Charlotte, who is former head of credit education for NASCO, the National Association of Credit Services, and chief operating officer for CRE Credit Services. My personal experience of having gotten to meet James over the years and getting to know him very, very well, also finding out more about his background and experience, having been a part of the elite Experian legal and compliance team, the Consumer Affairs Specialist Services Task Group, for several years in the late 90s and early 2000s. He's one of the true experts in the field of helping customers manage and win the credit scoring game. And so I've asked James to share with us today some of his knowledge, insight, and depth of information about how to help customers enhance their credit scores in a legal and ethical manner to win the credit scoring game, get better terms and better availability and access to financing for purchasing of homes. So with that being said, James, I'm going to let you take this and run with it for a couple of minutes, and then I'll come back in the Q&A, and we'll tag team a little bit more towards the end of the program. With that being said, James, take it and run.
Sounds good. Well, good morning, everybody. Hope everybody's having a great start to their day here. What we want to do today is get you guys an intro. We're going to have a four-part series come up here as well, but we want to get into some of the initial kind of meat of what credit services, credit scoring, credit reporting, myths and misconceptions, ethics, and then a concept that I call the gray areas I'll define here in a second. Get you guys kind of whet your appetite to see whether or not this is something you'd like to learn a little more about. So first of all, talking about the definitions here. When we're referring to credit scores, we're referring specifically to what is a mathematical algorithm that is used to try and determine the risk that your potential borrower is going to have. And it's a pretty complex mathematical algorithm made up of a series of other algorithms. And that concept will come into play quite a bit as we go through this. Credit reporting, what we're talking about here, are credit reporting agencies. There is a difference. Often they get called bureaus, but that's a little bit of an erroneous definition. Reporting agency like Experian, Equifax, or TransUnion, what they are tasked with doing is simply storing data. That's what they get paid to do. The major creditors, or all the creditors that store information there, they're subscribing to their service. And that's why a lot of the times when you're referring or speaking about credit reporting, you'll hear creditors like Bank of America, Express, NCO Collections, etc., referred to as subscribers because they're subscribing to the service of a credit reporting agency. A credit bureau, on the other hand, are the companies, the third-party companies that sell information directly to mortgage companies and car dealerships. They are regulated under the same law as credit reporting agencies, but it is a separate field. Okay, and a tri-merge, this is one of the reasons that bureau gets used so much, because you see a bureau report or a tri-merge bureau report. That's because it's purchased from a bureau, and it's when that company, that bureau, tries to take all of the information from the three major credit reporting agencies and merge it together into one kind of cohesive report. It doesn't always work all that well, and later on in the series we'll talk about some of the problems that occur there. Nonetheless, that's what a tri-merge is in that case. A consumer report or a consumer tri-merge, on the other hand, is something that the consumer buys themselves off online or directly through the mail from the credit reporting agencies that lists the trade lines side by side through the credit reporting agencies so that they're comparable. Okay, so it's a little bit different with a consumer report versus a mortgage tri-merge. 6, risk and ethics. There's two kind of concepts here that seem to go hand in hand, but I'm going to explain them just a little bit differently. When we talk about risk throughout, not only today, but throughout this series, when we're talking about risk, we're talking about what is the risk that someone that's borrowing money won't repay it. It's the bedrock foundation that all of these industries are based on. Be it credit scoring, credit reporting, credit credit bureaus. All these multi-billion-dollar industries exist because of this one word of risk. When you're talking about ethics, especially ethics of credit repair or credit services, we're talking about not doing anything that would be construed in any way, shape, or form as fraud. There are ways to ethically and properly help someone, counsel them, educate them, work on their credit report that is simply enforcing their rights without doing anything that would be construed as something that's trying to misrepresent themselves. In fact, contrary to maybe popular belief, sometimes, in my opinion, the credit scoring algorithms misrepresent the risk of a consumer. If somebody has gone through a divorce, for example, 2 years ago, and now they're happily remarried and haven't missed a payment since the divorce, but because of what happened between them and their former spouse, the risk score is making them look like much higher risk to not pay than they truly are. We're trying to correct that, not make them appear like something they're not, make them truly appear the way they are as opposed to the way they're being represented now. So that's, when we talk about ethics, that's the kind of the starting area for what we're talking about there. And then lastly, for the definitions going forward is the gray area. And what this has to do with is not having what most people want, unfortunately. Everybody wants a hard and fast, black and white, simple answer, where 1 + 1 always equals 2, or A + B always equals C. And unfortunately, in anything financial, anything credit, whether it's the credit reports or investing in stocks or your anything, there's going to be some gray area, whether it's interpretation of the law, whether it's new laws, whether it's case law, whether it's human error. There are going to be things that I wish I could tell you, and it's always going to go, 1 + 1 + 1, but that's not the way that it ends up working out. Let's move on to that. We're going to get into just a few topics here, a little bit more into the nitty-gritty, so to speak. Pulling up the next one here. So, first thing I want to talk about, getting into the specifics, are that scoring algorithm. We mentioned it earlier. How exactly does that work? Well, first of all, I have a feeling that if you were to do one of those kind of David Letterman man on the street interviews and go talk to most people, they would tell you that they have one credit score. If you ask them, how many credit scores do you have? Well, I've got one credit score. Everybody's got one credit score. There's this kind of this misconception that I've got this one number floating in the ether, and that's what defines me to every creditor. That is, I think most mortgage people know that, maybe not to the extent we're going into here, but that's not the case. Obviously, at the very least, maybe you find a few savvy consumers that say, well, no, I've got 3 because there's 3 credit reporting agencies, and each one of them has a score. But the reality is that even that's not true. You have lots of different companies providing credit scoring algorithms. You've got, of course, Fair Isaac Corporation. They make FICO. They're the largest by far of everybody that provides credit scores. And they have 23 models right now. They're about to have a 24th that we'll talk about here in a bit. You've also got Equifax has its own scoring model, Beacon. TransUnion has Empirica and TransRisk. Experian has Plus Score. You've got Vantage Score out there. You've got National Risk Score out there. There are a multitude of different scores. And then, not only can each one of those scores be applied to each of the credit reporting agencies, but you can also have an industry-specific score. So you can have, out of Fair Isaac's 23 models, you can have Fair Isaac Classic 04 with an auto enhancement. That's going to put a higher emphasis on the consumer's automobile payment history, both positive and negative, in deriving that final score. And there's multiple industries that have their own version: mortgage, auto, insurance, credit cards, student loans, et cetera, et cetera. So the answer is, how many different models are there and how many different scores could I have at once? Thousands. Absolutely thousands. There's so many different ways to interpret risk, and each of the banks can have their own individual tweaks on it that change it. So there's thousands of different ways that you can have it done. And then when you talk about the ranges of those different scores, I think that probably the most common range people think of is 300 to 850, that your score is going to fall in that range. Well, that's because the original Fair Isaac scoring mechanism that was created back in the 60s, that was the range on that score, was from 300 to 850. But you've got modern FICO scores that go 350 to 850. You have some that go 374 to 824. You've got Empirica that goes 200 to 900. You've got Vantage that goes 500 to 999. And you get a lot of consumer confusion as a result. And I think for the mortgage industry, it's frustrating for you because you have customers that walk in and say, oh, I'm a 700, and you pull it and they're a 590, and your question is, how can it be so different? Well, it's simple. They went to Experian.com and they ended up pulling what's called a Vantage score, because Experian is a part stakeholder in that company, so they resell Vantage scores. And the customer saw a 710. Well, Vantage goes 500 to 599 is an F. 600 to 699 is a D, just like we were in school. So as you can imagine, the 700 range is a C. They're 710. They're a low C. Well, a low C would translate into a score somewhere between probably 590 and 610. So that's where that huge discrepancy comes in, and what you're seeing and what the consumer's telling you they have. And that obviously that can be even more radically different than that. On a national risk score, the range is 1 to 999, and in that instance, it's supposedly predicting how many people out of 1,000 would default on the loan in the next 12 months. So as you can imagine, if it's 999, well then 99.9% of people would default in the next 12 months. If it's a 1, then 0.1% or 0.01% of people would default in the next 12 months. So it's predicting something on it's trying to predict the same thing as a FICO score, but the number means something totally different. So, you better let a consumer maybe come in and say, well, my score's 25, and you kind of laugh at them. Well, no, they might have been told that because they were, that would probably translate into high 7s, low 800s on a FICO score. So it's a very good score. So it's just, that certainly can create a lot of consumer confusion. Going into utilization, I've talked about all these other models, and you get consumer scores being used a lot, not for lending purposes, but to sell to customers online and to make money that way off of, as opposed to the standard credit scoring, credit reporting model. Realistically, the highest utilization of scores, far and away, is from Fair Isaac. I mean, virtually every mortgage company, any mortgage that's being done through FHA, RD, USDA, Ginnie or Freddie or Fannie, those are going to have a Fair Isaac model on them, and they control somewhere, just depending on what statistics you believe, somewhere between 65 and 75% of the total scoring market. So, of course, Fair Isaac is still the highest utilization, but those others are out there and consumers can get their hands on it, and that's where a lot of that confusion comes from. And then the last part I said earlier, gray area is something we're going to talk about, not only today a lot, but just in general throughout the other courses, because it plays such a huge role in really understanding what's happening in the real world, not just in the theoretical world and the legal world, but what the boots on the ground see. And with credit scoring, it seems like most people think, well, it's math, so it's got to be black and white. That's just not the case. The gray areas with scores are all over the place. Number one, show something here. This is one page. I don't know if you can see that real well. This is one page of 6 of the codes that go into the modern Fair Isaac score. Now, this one is the codes from the original Fair Isaac score. Every one of these codes, be it presence of derogatory public record, number of accounts delinquent, length of the time since legal item filed for collection, amount past due, number of accounts opened with the last 12 months, number of recent inquiries, number of finance company accounts, all of those impact everything else in the score. You can have, if you don't have as many finance accounts as someone else, then maybe the inquiries won't impact you so bad. If you have too many inquiries, then the finance accounts might affect you worse. All of those things impact someone else, and it makes it hard, next to impossible, to tell you just this is what's going to happen if you do this, because it's going to be different from you than other people. It's a fingerprint. If you have someone that has a long 20-year positive payment history, maybe the banks are going to trust them to have 15 accounts with balances before they start to negatively impact the score. Whereas if you only have 4 years of positive history, your score might be negatively impacted by having more than 6 accounts with a balance on them. It's just going to be different for everybody, and that's one part of the gray area that comes in. The other part has to do with how they tweak the score themselves on a regular basis. And what it has to do with is a score is supposed to be predictive not only based on these kind of theoretical economics and statistics, but also on the real-world, real-time behavior of the general public. So if they're doing tests all the time, Fair Isaac or Experian, and then adjusting the score according to the behavior. So, for example, they might take 10,000 people that had a late payment on their automobile 6 months ago, and look at where are they now. Do they have new late payments on their mortgage? Do they have new late payments on their credit cards? Are they continuing to have late payments on their cars? And if the number of people that are doing that today is statistically significantly different than the last time they did that same study, then they will tweak the credit scoring algorithm accordingly. So let's say it's we're seeing a big uptick in the number of people with mortgage payments, with that late payment on the car being a leading indicator. Now, you have a customer that had a late payment on their car 2 months ago, but they've got good income, they've got good everything else, they still have a 650. So you're able to get an exception at a 650 to get the loan done. And then that day, they do that study and tweak the algorithm. Now, the next day, you pull her report again. Now, nothing's changed on the report, which even that's not really true, because every day things change on the report just based on the passage of time. Every day is another day since the most recent inquiry. Every day is another day in the average payment history of the account. Nonetheless, nothing but time has changed on the report. You pull it again, and today she's a 635. Well, the reason her score dropped 15 points is because in the background, they found that late payment she had 60 days ago to become more predictive. So now you lose your exception because of that. It's frustrating, but it's worth it. I want you to know how it really works. So that's just a couple of little areas of gray area that we will, of course, through the courses, expand upon more. And the next thing that I'd like to talk about also has to do with scoring, but it's one of those things that's a little bit more relevant right now because it's almost kind of a current event. Let me see if I can get this slide to advance. What it has to do with is if you guys were watching the news about, well, I'm going to say 8 or 9 weeks, but today is October 24th, so if you're listening to this in the future, it might be more than that. But nonetheless, on a Friday, a couple months ago, there was a press release from Fair Isaac Corporation. And what it was discussing was their new Generation 9 scoring mechanisms that are coming out this fall. Actually, they should be released in the next couple of weeks here. 2 huge changes. Number one was that medical collections were going to be lessened, whether they're paid or unpaid. So even unpaid medical collections were not going to be counted as much in this new algorithm as regular collections would. And then the other, even more eye-opening change was that paid collections were going to be excluded from the credit scoring algorithm entirely. That is an about-face. Fair Isaac doesn't like to talk about this much. They actually did admit to it, so to speak, in this public announcement, was that a paid collection and unpaid collection, they pretty much impact you the same. Obviously, it's less risk to have a paid collection than an unpaid, so you could pick up something as far as points go by paying a collection, but it's going to be very, very minuscule because there's very little difference between a paid and unpaid collection. So obviously, this would completely destroy that. Paid collections wouldn't be factored in the score at all. Wow, what a huge revelation. How great for consumers. And it got them a lot of press, a lot of positive publicity. And to be honest, it sounds great. It sounds like those are things that would be steps in the right direction for consumer advocacy. However, unfortunately, it really changes nothing. And I'm going to explain why. The first part is, as we mentioned earlier, how many scoring mechs are out there right now? Fair Isaac already has 23 that they're selling briskly. It's not like they're going to take those off the market and force all their customers to do this. They've got competition out there as well. Not everybody is using Fair Isaac. A lot are. But this is just one new model from Fair Isaac. Well, banks and mortgage companies and automobile dealerships and collection companies, everybody else, they buy scoring mechanisms based on their own internal risk. They do depend on Fair Isaac a little bit for some advice, but realistically, they know what their risks are. They know what they feel, what kind of borrower they want to lend to. And up until this point, those banks have wanted medical collections in the score. They have wanted paid collections in the score. If they didn't want them there, then certainly Fair Isaac would have put them there. Fair Isaac is the retailer in this case, and Experian Equifax, well, I should say the bureaus are their customers. So their customers, and the banks, they see a need to have this in there. Just because Fair Isaac makes this available doesn't mean that any of those banks anywhere are going to change their internal risk model and start purchasing that from. It's something nice for consumers, but I have heard zero indication that any bank plans on using this new scoring generation. Part two, and this same kind of thing, but very particular to mortgage, I mentioned GSEs like Ginnie and Freddie and Fannie earlier. Well, they all have their own internal risk models as well that they require any loans that they're going to insure to conform to, as I'm sure you're all very aware. if you go and look at your reports, if you're doing a lot of government-backed loans, which I'm sure most of us are doing, almost nobody's doing nothing but super jumbo loans. But so if you're doing anything that's government-backed, go take a look at the scores. I think there's a high probability that the scores that you're going to see most commonly are Fair Isaac Classic 04 being used to score TransUnion, FICO V2 being used to score Experian, and Beacon FICO FACTA Enhanced being used to score Equifax. And the reason that you see those three particular models for those three credit reporting agencies most often is because those are the three that are risk approved by the GSEs to use. Those scores came out in 2004. They are Fair Isaac Generation 6. Fair Isaac Generation 7 came out in 2008. Generation 8 came out in 2012. And we have Generation 9 coming out here this fall. They've been trying to risk approve Generation 7 since it came out 6 years ago, and they haven't been able to do that yet. One would assume that they would have to approve that and then Generation 8 before they could even get to starting to approve Generation 9, if they're ever going to do that. Based on that alone, for any government-backed mortgage, you're looking at a bare minimum of a decade before these scores can be used, if ever. And then third, and perhaps most importantly, we'll talk about errors a little bit more here in just a second, but in order for any credit score, even the current models, to work properly, all the information in the credit report has to be coded properly. So you can't have Midland Collection showing as a revolving account that's 90 days past due, even though that's how they tend to report. When you pay that, it just shows up as a paid revolving account instead of paid collection, so the algorithm wouldn't be able to exclude it anyway. So for any of these scoring metrics to work right, including the new version 9, you'd have to have appropriate, accurate, complete data on the credit report, which we know is just not happening the way that it should. And you see in the slide here, the last part says, will anyone use it? I think I've pretty much already answered that. If so, it's a long, long time coming. It is, the score model will be available for purchase, come up here in just a couple weeks. It was in 2014, but I don't anticipate it being used in the general market for a very long time. I think that what you might see are some very kind of forward-thinking, left-leaning companies that there's not a whole lot in finance, but think kind of like a Starbucks or a Google. Some company like that that's in finance might say, oh, well, I'm going to use the consumer advocacy scoring model, and that's going to be great publicity for them as well, but you're not going to see just, a huge deluge of companies trying to use this anytime in the near future. Now, what I mentioned at the end there, the errors, that's the last thing I want to make sure it get covered today, is the errors in credit reports. Back at the beginning of 2013, in February actually, 60 Minutes, there was a whole weekend that was very heavily focused on the credit reporting industry, and you had 4 reports kind of all come out at the same time on Friday, on Sunday, on Monday, and on Tuesday. That all had, well, 3 of the 4 had very similar, if increasing in magnitude, indictments of credit reporting agencies. So I'm going to tell you a little bit, if you're seeing the slide, they're a little bit out of order here. I'm going to start with the CDIA. For those that don't know, the CDIA is the Consumer Data Industry of America. It is a trade organization for credit repair organizations and bureaus and rent debt and check systems and those types of organizations. Basically, anybody that's regulated by the Fair Credit Reporting Act, they have a voice in through lobbying efforts and things with the CDIA. Well, the CDIA did their own report, and they came out and said, oh, we believe that only 2.5% of information is misreported to the credit reporting agencies. To me, that was a little bit of trying to get out ahead and trying to save some face for what they knew was coming in the next few days, because 60-Minute expose came out on the Sunday right after that report, saying that 45% of all trade lines are reporting in error to the credit reporting agencies, or rather by the credit reporting agencies. Their supposition was more that the errors are created by the systems in place at the credit reporting agencies. They didn't even talk about nefarious third-party collection companies deliberately reporting this information. That wasn't the focus of it. The focus was on information that gets reported wrong, or because of communication errors or human errors or things like that. So that was Sunday. And then on Monday, the FTC report comes out in conjunction with the CFPB, and they say 25% of credit reports have errors on them. severe enough to keep someone from getting lending, or they're just as, if not more damaging than and well researched as the 60 Minutes report. And then the next day you have the National Consumer Law Center coming out, and their numbers are astronomical. They believe that the number of people that are impacted by misinformation is in the 80 percentile range. So we're not talking about, unfortunately, 1 or 2 people out of a million, or the numbers that it probably should be. I mean, I understand that nothing's ever going to be perfect, but the level of error and misrepresentation and misreporting that exists right now, it's unacceptable. That's quite frankly why I don't work for Experian anymore. I actually didn't say this at the beginning like we do sometimes, but one of the things I had to do for Experian is when they would be sued in federal court, I would be deposed and help to prepare our defense against them. And you see kind of the magnitude of errors that go in and how people are negatively affected by it. I wanted to actually talk, if you're seeing the slide, to see these on here, about a couple of the errors that are very common. This is just, again, the very tiny tip of the iceberg, but they're extremely important. One is ODD versus DLA is what it says on the slide. Date of last activity is something that a lot of mortgage professionals think is important to the credit score. It's actually not something that would ever impact the credit score because it's not something that's recorded. DLA is something that shows up on a bureau report that's not actually on the consumer credit report. It's not in the raw data. The bureau takes some date and puts it in there. Now, it is possible that date could be ODD. ODD is actually the concept that is probably one of the most litigated in all, I would say the most litigated in all of credit reporting, and it's determining when that 7-year time period starts to run for a trade line that can legally be a negative trade line, how long it can be on the credit report. When does that 7, is it when it's charged off, is it when it's collected? Well, no, it always, for every trade line, runs from the ODD, the original delinquent date or original date of delinquency. Either one is proper. And that has a very clear definition. It's the first missed payment that leads to the most negative status without becoming current again. So that means that they missed a payment and then they never got current. So maybe it rolled. Maybe it was a mortgage that went 30, 30, 30, 30, 30, 60, 30, 30, 60, but they were never current again. That first, in that one I just talked about, even with 10 late payments or whatever it is, that entire string of delinquency would have to be deleted 7 years from that first 30-day payment. Not the 60s, not the last one, but from the first one, and they would have to take all 10 of those late payments off. Let's say they got current after that 10 months. So you have this string, 10 months of delinquency. That entire 10 months would have to be removed from the credit report 7 years from that first 30-day late payment. And that works whether it's delinquencies or derogatory accounts. So let me give you an example. You've got a Chase credit card, and I'm going to tell you today is October 24th, 2014. Okay. Well, they went delinquent on this account on November 15th of 2007. They went 30 days late, and they never made another payment. It was 30, 60, 90, 120, 150, 180 charge-off. And they've been a charge-off ever since that point. Okay. So today, here we are in October of 2014. That account's on there as a charge-off unpaid. They only get to report that account until November 15th, until next month. That's the maximum legal time they can report it, 7 years from the first missed payment. Okay. Now, let's flip that a little bit. Let's say that Chase had sold that to NCO Financials, and they're reporting now too. Well, they sold it 2 years ago. So their open date is November 15th, 2012. That doesn't matter. The original date of delinquency is sticky, not only with the original creditor, but with the debt itself, because now it's a negative debt. It's negative information. So even though it's sold to a third-party collection, that negative debt, that negative balance has already been on the report for 5 years. So NCO only gets to legally report that for 2 more years. They're from when they bought it. So now here we are now. Next month when Chase deletes, NCO is required to delete their trade line as well. That's one component of ODD. At the same time, Chase should not have been showing a balance since they sold it to NCO. When a first party gives it to a third-party collection, they're required to show their account as transferred, closed, was a charge-off, 0 balance. You can't double report the balance. The consumer doesn't legally owe it twice. They only owe it once. That's another way that you see a lot of errors like that on the report. in the interim, let's say Chase had sold it to Asset Acceptance, who sold it to West Asset Management, who sold it to NCO, and all of that happened within a 6-year time frame. Every time it was sold, so when Asset Acceptance sold it to West Asset, they're required under federal law to delete their trade line. When West Asset sold it to NCO, they're required to delete their trade line. You can only have one third-party collection for one original creditor showing legally at any time on the credit reports. Okay, so that's ODD in a nutshell, and obviously there's a lot more nuances and things to that, but it's something that gets misreported more often than you can imagine. Well, and I'm sure anybody in the mortgage field, how many times have you seen multiple collection companies for the same debt? How many times have you seen a collection company reporting for Capital One? Capital One deleted a year ago. Well, Capital One probably deleted because they were out of statute and they removed it after 7 years, and now the collection company is reporting illegal. That happens, unfortunately, more often than the legality part happens. It's much more likely to be reported illegally than legally, especially with third-party collectors. Okay. Last thing I want to talk about now, obviously, I've been deposed on this kind of stuff for as long as 4 hours before. I could talk about it for eons and bore you all to death. But coding errors is something I want to talk about. A lot of times, we mentioned it earlier with Midland Collection, you can have accounts that are intentionally coded wrong. The appropriate rating for any third-party collection, and if you guys all remember, they don't do it as much on bureau reports anymore, but every trade line used to have a rating, R1, M1, I2, that says what kind of account it is, R for revolving, M for mortgage, et cetera, and a number. 1 is a current account, 2 is right now 30 days past due, 3 is 60 days past due, et cetera. Every account has one of those letter number ratings, whether you see it on the bureau report or not. Third-party collections should all be a Y9. Okay? Well, why do collection companies have a separate letter? Or why aren't they just an I, like an installment account, or an O, the other, where like utilities go and things like that? Why are they a Y? Well, it's because we were talking about all these different codes that go in. Some of them shouldn't be affected by a collection company. For example, most recent account opening. Well, obviously that little part of the algorithm takes all of the open dates for all of the accounts on file and says when was the most recent. Well, if that collection company is not coded as a third-party collection, if it doesn't have a rating of Y on it, then it's going to factor into that, even though it really should. If the consumer didn't truly open an account, they had no control over that. Likewise, sometimes you'll have collection companies that go and pull inquiries, hard inquiries, when they're not supposed to. There's all of these things that they do that they shouldn't, even though because they don't code themselves the way that they're supposed to. And why do they do that? Let's be honest. Because they want to make more money, and a consumer is more likely to pay the debt if it's more of a negative impact on the credit score. So if I can do just a little couple tweaks that I'm exceptionally not likely to get caught for, I mean, the rewards here far outweigh the risks, and I'm a third-party collection company, chances are I'm going to do those. I'm going to make those little tweaks to impact the score far more negatively, because that's going to increase the likelihood. If that person ever wants to go get a credit card or get a mortgage or get a refinance, they're going to probably have to deal with me first. And I want to do everything in my power to make sure that happens. Eric, I think that's what we wanted to make sure was covered this time. Do we want to answer any questions? I think there were a couple.
Let me hop in here real quick, James, and just talk to the folks about something that's coming up as an opportunity. Obviously, James is, as you've probably seen, is probably one of the premier, my personal opinion is I've yet to meet anybody else in my almost 20-year career in the industry that has the depth of knowledge that James does of how to affect the nuances of the different scoring algorithms, as you said. I mean, I learned more from the first time I heard James speak in a 45-minute program than I had learned in a 2-day credit scoring workshop that was put on by Experian back in 2012. And I've asked James as a favor to our audience and to our membership to put together a training program that will help you understand in much more intimate detail the nuances of the scoring models, what coding errors are to look for, how to look for them, and how to really help your clients win the credit scoring game. I mean, as James mentioned and alluded to here, I mean, we all know that credit scoring is I mean, think about it, if you think about it like a sports contest or a competition. You get positive points for things that you do that are considered to be responsible use of credit. You get negative points for things that are considered to be irresponsible use of credit. Well, as mortgage and real estate professionals, part of our job is about helping customers understand how to better manage that game and how how to build a higher credit score, because the advantage is they, one, get qualified for a home loan, and two, have the opportunity to get better terms if their scores are better. Now, we're not talking about manipulating or misrepresenting relevant credit data that has an impact on a borrower's ability to repay a loan, but what we are talking about is making sure that stuff like that third-party collection example of them reporting it as an I-9 instead of a Y-9, and how negatively that could impact somebody's score, several hundred points potentially, how that can be adjusted and corrected in an efficient manner to be able to help those borrowers really have an accurate score representing their real ability to repay. And so what we put together is we're going to be starting a 4-part web shop. These will be an hour in length or a little more, starting at 3 o'clock Central Time, 4 Eastern, 1 Pacific, on Monday, November 3rd is going to be the first date of the program. It's actually a 4-part web shop series. Obviously, there is a bit of expense in putting this program on, so there is a cost to it. But if you think about just the investment, I mean, regularly the program would cost $497. We are offering it today for only $297 if you go ahead and apply the discount code of CREMAX, in all capital letters, CREMAX. Of course, if you're interested in enrolling in that program, and think about it for just a moment though, can you really afford not to participate in this program, to get the knowledge, the information, and the training you need on how to accurately and effectively communicate what borrowers need to do to affect their score positively? I mean, you do one additional loan in 12 months, you're getting a 5 to 8 times return on your investment for only $297. I mean, you know, beyond that, by the way, we've decided to add it just prior to recording today's session. We decided we're going to add actually a 5th session that'll carry over on that 5th Sunday, where I'm going to talk about, after James has shared with you the information about what you need to know about the scoring models and how to use that information to educate consumers in your community, we're going to do a bonus session that's going to talk about how to market yourself as a certified credit coach and how to leverage that knowledge and that credential to be able to get yourself in front of a lot of audiences that are going to be very interested in finding out more about how to help enhance their scores and improve their ability to qualify for a home loan. And of course, that bonus session is going to be offered to people watching this video for no additional charge. We're just going to throw it in as a bonus to talk about how you can get yourself in front of potentially hundreds of customers who need help and guidance and support on how to win the credit scoring game, along with this ongoing designation that we're putting together. So if you want to go ahead and get access to the credit scoring, winning the credit coach, winning the credit scoring game, how to become a certified credit coach class, that'll be starting on November 3rd. All you need to do is go to our website, mxlcoach.com/shop. You'll click here to get into the shopping cart, or you can even click directly on the links with the CRE Credit Services Become a Certified Credit Coach class. That'll take you to the shopping cart. You'll apply the discount code CREMAX, and that will allow you to go ahead and register for that credit scoring game, that class. Now, I guess there's a couple of questions, James, that have been posted that we're going to jump back to here really quick. Do me a favor, let me open the chat box here so I can get this up and running for us. Let me see, what was the one question? Wow, these things have scrolled through fast. It's a little bit hard to actually pull them all up. Bear with me just 2 seconds while I try and get this to where I can see what we're looking for. Let's see. One of the questions that was asked in here, sorry, trying to move some things around on my screen so I can actually see all this stuff. Gotta love these kind of things. Anyway. All right, so we've got a couple of these different things going on. Let's see, one of the questions that was asked here, where'd it go? Oh, there it is. Went too far. All right. Question asked by Melanie was, client with an unpaid collection account showing on credit. He is certain the original date of delinquency is 7+ years old, but the collection agency is showing as 10/13, October of 2013. How do you dispute?
And obviously what I'm going to talk about here is what we would do to address that. Obviously, we would try and find as much information by contacting the original creditor if possible, and the third-party collection, see what documentation they have to prove it, and then based on what we can find that's reporting completely inaccurately, obviously the original date of delinquency based on what he's saying, we would send that directly to the credit reporting agency, and then we would send a demand to the third-party collection themselves saying you need to remove this. This is out of statute, citing the laws and given the proof that we've found. And it's complicated, of course, and knowing the laws is very important. But that's the way you would want to address that. You don't want to go just to the credit reporting agencies or necessarily just to the third-party collection company. You want to go to both and make sure that you've expressed exactly what is incorrect and illegal about what's being reported.
Okay, cool. Another question that was posted here by Kevin. What do you think of consumers using credit repair companies telling them that they will delete everything off of the credit report when these consumers owe money?
Number one, nobody should ever advise you to not pay a debt that you feel you legally owe. If you owe the money, you owe the money. And what we're more talking about here is with credit repair should be the consumer's rights. There's a contract in place. Saying you're going to delete everything is exceptionally unethical. If something is reported accurately, completely, and verifiably as required by federal law, then there's no need to investigate it at all. Obviously, the biggest problem here is that information is typically not reported 100% accurate, completely, and verifiably. So what you're in a sense doing here is trying to enforce, or what a proper credit repair company should be doing, is trying to enforce the consumer's rights under federal and state law. And quite frankly, deleting stuff or removing the negative information isn't necessarily always the best thing. I mean, if they owe the debt, they owe the debt, and you don't want to misrepresent that to a mortgage company. But like we said earlier, if that debt is supposed to be costing them 20 points or whatever on their credit report, and instead, because of misreporting, it's costing them 50 points, well, then that's not fair to the consumer either, and that's not fair to the mortgage company. Maybe you can do that debt if their score is 30 points higher, but because of the illegal misreporting, that's not happening. And in that case, you don't need to delete that collection. You just need to make sure that the appropriate ODD, that it's coded properly, that's reported accurately, and the score is going to adjust with or without it being there.
Exactly, and it's kind of like that example you gave a few minutes ago, James, about the importance of the the coding and the ODD, and how important it is. Because it's, I mean, I'm going to ask this for my own curiosity. What percentage of the time when you guys look at consumer reports do you see third-party collection agencies, miscoding and misreporting stuff like that?
Unfortunately, from our perspective, the numbers that we take, because obviously I come from legal and compliance. I'm a metrics guy. I want to see it, and we see in excess of 90% of the third-party collection trade lines with some error that could negatively impact the customer more than it should. So, and sometimes it's not on all three. Oddly enough, sometimes it might be correct on Experian, but then they've got the ODD 2 years different on Equifax. So, 2 years further into the future than what it is. So it's, sometimes even being able to find it and isolate what the problem is difficult because of the obfuscation using different credit reports in different ways. And let's be honest, especially if it's a high enough balance, maybe you don't have to take the risk to put it on all three misreported. You can put it on just one credit report misreported, but because it's a high balance collection, even though it's out of statute, the fact that it's there could hold up the loan and increase the likelihood that they're going to get paid. So it's, when you take it as the trade line as a totality across the three credit reporting agencies, we see in excess of 90% reported in error somewhere.
Wow, I mean, that's a staggering statistic. I know the reason I asked the question, obviously, is as a lender and as an originator, I've seen that happen far too often. I think the hardest part, I think, is how often they will actually report the date they acquired the collection account actually in the original date of delinquency box. So, we've seen collections for even $50 or $60 pop up that drop somebody's score 100, 120 points, and it's because these third-party collection agencies are just erroneously and abusively misreporting the information. All right. Well, one last question I want you to cover real quick, and then I know folks are going to want to get on to what they need to do today. There was a question asked here by Gerard. Which software versions are being used now for each bureau, and how do they differ in terms of scoring, and is there any bureau easier to increase than others? It's kind of a four-part question, but
yeah, no, that's fine. But it's both easy and complicated to answer, because here's the thing: each of the credit reporting agencies have their own internal software. Each of the bureaus have their own internal software. There are some things they share. eOscar is a shared component. It was, I'm sorry. Okay, sorry, I had a webcam issue. They all have their own software they use. They share some. eOscar was developed by Experian, but that's used to convey electronic disputes in the background. You have the fraud clearinghouse, where FACTA, the Fair and Accurate Credit Transactions Act, required all the credit reporting agencies to be able to share information about identity theft through a single place. But in general, everybody develops their own scores. Everybody develops their own software, and new versions of that software come out on a regular basis. Just like your iPhone software changes from 8 to 8.01 to 8.02 to 8.1 all in the course of 3 months. Well, those same kinds of things are happening with their software too. They're changing all the time, and they're not necessarily telling their competitors. I mean, that's another part of this. To be honest, Equifax, Experian, and TransUnion, they hate each other. They're competitors. They're competing in the same market. And they're not, oh, hey, guess what, Equifax? I just did these changes to my software. Well, no. I want to market that. I want to go and say, hey, I've got new updated software that they don't have. So they don't necessarily have to even disclose to us which software they're using. As far as who tends to respond, it just depends on the situation. So, for example, Experian, because they have a little bit more sophisticated system, they're by far the biggest of the three and have the most global presence. When it's something that they know that they have exposure on, like misreporting information after a bankruptcy, which is very common, Experian is typically the easiest and fastest to properly fix that. You contact them about information misreported after a bankruptcy, odds are they're going to get it fixed pretty quick. On the other hand, TransUnion, they're the smallest, and they take on the smallest companies. So they have these kind of, rinky-dink is the best way to put it, a little local collection company that only has 200 active accounts, that Experian and Equifax wouldn't even take them on. It's just not enough data for them to be relevant enough to even report. But TransUnion will take them on. So if you have those kind of collections on there, those tend to be very hard for those types of companies to validate. Sometimes there's questions as to whether or not how many times has this customer already paid this collection to other companies before it was sold and resold and resold again. So, TransUnion understands the problems there. So those tend to be a little bit easier to get removed off of TransUnion when it's the ones that are only reporting there. Some medical collection companies that only report to Equifax, they're usually domestic companies. Those tend to be a little bit easier to investigate because they just don't have, the question exists whether or not the debt's even owed. Did insurance actually pay? Was it paid after or before the fact? So there's certain instances where every one of them has their strengths and weaknesses, but like I said, it's gray area. It's different across the board, depending on what situation it is and which entity we're dealing with.
Yeah, definitely. All right, well, guys, I know you want to get getting on with the rest of your day. Thank you for joining us today. The one final comment and suggestion, I mean, we've just barely even begun to scratch the surface today in what we need to be looking for and where are the areas that you can make a big difference in helping borrowers with their credit scores. One of the best options is you're more than welcome, and we really hope and encourage you to participate in this Winning the Credit Score Game class. By the way, you will earn the designation of becoming a certified credit coach as a part of this program. To go ahead and enroll in the program, just remember, go to the mxlcoach.com website, mxlcoach.com/shop.html, or if you just go to the mxlcoach.com website, you can click on the Shop tab. You'll see the information there about how to get access to it. Of course, once you get into the shopping cart, go ahead and hop on over to where the registration page is. Type in the code CREMAX, and it will knock the $497 regular price down to $297 when you apply the discount code, and that will get you set up and registered. Watch for an email as soon as you register for the instructions on how to create your Access account on the platform that we'll be using for that training class as well. And we look forward to working with all of you. And don't forget, by the way, those who register and go ahead and take advantage of this on the early bird special are going to get the bonus session, the How to Market Yourself as a Certified Credit Coach class that we'll be doing on that 5th Monday in the series at no additional cost. So can you really afford not to create the, get the education and information about how to really truly become the certified credit coach, credit expert in your community, being able to put yourself in a position to go out and speak in front of industry groups in your community, large-scale employers doing lunch and learns at program, at local manufacturing and employment companies. There's a number of different ways you could market this information, and we'll talk about a lot of that on the bonus session, but you need the knowledge first. You need to understand some of the nuances and intricacies of how the credit scoring game works so you can help your clients win the credit scoring game and do more loans as a result, close more deals as a result. So I want to thank all of you for taking the time to join us on today's webinar program. Obviously, watch for upcoming events and information in the Maximum Performance webinar series. Of course, you can always go to the website, mxlcoach.com/webinar, and check out upcoming events. Again, want to applaud you for taking a few moments to join us today. Take the knowledge and do something with it. Think about really seriously, can you afford not to take the time and invest the little bit of money that it would take to get this extremely valuable education to learn how to help your clients win what is one of the most complicated and challenging parts of the lending process so that you can really help more borrowers achieve their goals for home ownership. Thanks again, James, for joining us today. It's really been fun having you on the series again. And very much look forward to having you back in future events as well. But I'm very excited and thrilled about how this class is going to go. And I know you've got a ton of information. I've been talking behind the scenes on how to put all this together for weeks, and I'm very excited to see how it's going to go. All right, folks, thanks again, and we wish you all the greatest success. If there's anything else that the team here at Maximum Acceleration can do to help you achieve your goals faster, please don't hesitate to reach out to us and ask. And we look forward to seeing you on an upcoming event.